Live from New York City this morning. Good morning, good morning. Still recovering from last week. Equity futures just negative by 1/3 of 1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
We begin with the big issue. Face-to-face in Bali, President Biden and China's Xi Jinping wrapping up a 3-hour meeting calling for reduced tensions. The White House publishing a readout. Writing the following: President Biden raised U.S. objections to the PRC's coercive and increasingly aggressive actions towards Taiwan. He also raised ongoing concerns about China's non-market economic practices. Both leaders agreeing that, quote, a nuclear war should never before. At the very bottom of the U.S. readout, confirming that Secretary of State Antony Blinken would be traveling to China. The news conference with President Biden was set to start about 30 minutes ago. When it begins, I'll bring it to you. We're lucky to have Brian Gardner of Stifel join us right now. Brian, as we wait for the president to come out, what did you make of what you've heard so far?
Kind of in line with expectations, right? We had low expectations. There weren't going to be any deliverables. There weren't going to be any new announcements of new initiatives or any kind of agreements. So it's kind of in line. You know, I think it's generally a positive. Always good to have world leaders meeting, especially given the heightened tensions between the two countries over the last couple of years. But from what I've heard so far, I haven't heard anything that's really changed.
Secretary of State of Antony Blinken traveling to China, is that important from your standpoint, Brian? Is that a sign that things are thawing whatsoever? And what do you think's on the agenda there?
Don't know what's on the agenda. My guess is it's a sign of normalizing. You know, these meetings and these trips are kind of regular diplomacy, which has not occurred during a COVID era. So, you know, in some respects, you have to look at all of this through a COVID lens. I mean, these trips and meetings probably would have happened more frequently over the last couple of years, but with COVID, it was impossible. So I think, again, it's just normalizing what regular diplomacy looks like. And I think that's a positive for the markets generally.
Brian, that's good news. Let's go through things piece by piece in a readout we've had from the US side and maybe the points of tension. Russia. This came in the second to last paragraph. The two leaders exchanged views on key regional and global challenges. President Biden raised Russia's brutal war against Ukraine and Russia's irresponsible threats of nuclear use. President Biden and President Xi reiterated their agreement that a nuclear war should never be fought. Brian, what do you make of the current relationship between China and Russia? And do you think any of this was really addressed at today's conversation?
I think it was probably touched on. I don't think there was any new breakthrough on the kind of China-Russia relationship vis-a-vis the United States. So it definitely came up. I'm sure the Chinese have been taking stock of what happened in that area of the country, in Ukraine, over the last couple of years. And I think it kind of informs their decision on how they act going forward, not just how aggressive. It's not just a question of what the Russian response was and how weak Russia has looked, but how united the West has looked. And I think that and how Russia united so many non-aligned countries with Europe and the West and Ukraine. And I think that's the biggest takeaway and probably what China has been looking at most closely.
Brian, of course, a lot of people watching how Russia is dealt with, because as far as China is concerned, this is important for how Taiwan might get dealt with. In that readout from the White House, President Biden is said to have raised concerns about PRC practices in Xinjiang, Tibet and Hong Kong, and human rights more broadly. And we imagine they'll be addressed right now at the Grand Hyatt in Bali. Let's hear from the President of the United States.
Good evening, everyone. Let me start with a few words about the recent elections held in the United States. What we saw was the strength and resilience of the American democracy, and we saw it in action. And the American people proved once again that democracy is who we are. And there was a strong rejection of election deniers at every level, from those seeking to lead our states and those seeking to serve in Congress, and also those seeking to oversee the elections. And there was a strong rejection of political violence and voter intimidation. There was an emphatic statement that in America, the will of the people prevails. I've traveled this week And it's been clear just how closely the world and our allies and our competitors as well have been following our elections at home. Excuse me, I have a little cold. And what these elections showed is that there's a deep and unwavering commitment in America to preserving and protecting and defending democracy. Now, let me speak briefly about our agenda over the past few days in Egypt and in Cambodia and here in Indonesia. In this moment of great global challenges, from global inflation to the climate crisis to Russia's brutal war against Ukraine, we're bringing together the broadest possible coalition of partners to deliver results. At COP27 in Egypt, I made it clear that thanks to the bold agenda of our administration, we pursue from day one to tackle the climate crisis and advance energy and security at home and around the world. The United States will meet our emissions targets under the Paris Agreement. And we're going to keep working with our partners to support the most vulnerable countries in building resilience to climate impacts and to align global ambition with the 1.5 degrees Celsius goal while supercharging our clean energy transition. At the U.S.-ASEAN Summit and the East Asia Summit, I laid out a commitment to working with our partners in the Indo-Pacific to ensure a future that's vital to this region, that's free and open and prosperous as well as secure. And I met with our allies from Australia, Japan, and the Republic of Korea, underscoring our commitment and deepening our engagement with our closest partners and strengthening cooperation among our allies to meet shared threats to our own security and to their security, including the DPRK. And let me meet, I just met in person with Xi Jinping of the People's Republic of China. We had, we had an open and candid conversation about our intentions and our priorities. It was clear, he was clear and I was clear, that we'll defend American interests and values, promote universal human rights, and stand up for the international order and work in lockstep with our allies and partners. We're going to compete vigorously, but I'm not looking for conflict. I'm looking to manage this competition responsibly. And I want to make sure that every country abides by the international rules of the road. And we discussed that. The One China policy, our One China policy has not changed, We oppose unilateral change in the status quo by either side, and we're committed to maintaining the peace and stability in the Taiwan Straits. It was also clear that China and the United States should be able to work together where we can to solve global challenges that require every nation to do its part. We discussed Russia's aggression against Ukraine, reaffirmed our shared belief in the threat or the use of nuclear weapons is totally unacceptable, and I asked that Secretary Blinken travel to China to follow up on our discussions and continue keeping the lines of communication open between our two countries. Looking ahead at the G20 meetings tomorrow, we're going to be taking on the very issues that matter to the people's lives, not only here, but also our allies and our partners. That means tackling the suffering that Russian aggression has unleashed, not just in Ukraine people, but the people around the world, particularly food insecurity, and strengthening the fundamentals of our global economy for everyone. Support for debt relief, reforms for multilateral development banks, investments to bolster global health security, and to make sure the world is better prepared for the next pandemic. The G20 has been an important forum for the world's largest economies to work together for the good of people everywhere. And I'm looking forward to our meetings tomorrow. Now let me close with this. On my first trip overseas last year, I said that America was back. Back at home, back at the table, and back to leading the world. In the year and a half that's followed, we've shown exactly what that means. America is keeping its commitments. America is investing in our strength at home. America is working alongside our allies and partners to deliver real, meaningful progress around the world. And at this critical moment, no nation is better positioned to help build the future we want than the United States of America. Now, I'm happy to take questions, and I'm told there are going to be 4 questioners, but I'm not going to do 10 questions from each questioner. All right? Let's make that clear at the outset here. And Ken Thomas, Wall Street Journal.
You said at the outset of this meeting that you did not want do not want competition to turn into conflict. Based on this meeting today, do you believe a new Cold War with China can be avoided? And specifically on the issue of Taiwan, you spoke about the tensions. Do you believe China is preparing, intending to invade Taiwan at some point? And what warnings did you issue to President Xi if he were to take such action? Well,
to answer the first part of your question, I absolutely believe there need not be a new Cold War. I've met many times with Xi Jinping, and we were candid and clear with one another across the board. And I do not think there's any imminent attempt on the part of China to invade Taiwan. And I made it clear that our policy on Taiwan has not changed at all. It's the same exact position we've had. I made it clear that we want to see cross-strait issues peacefully resolved, and so it never has to come to that. And I'm convinced that he understood exactly what I was saying. I understood what he was saying. And look, I think the United States is better prepared than any country in the world, economically and politically, to deal with the changing circumstances around the world. And I think that Xi Jinping we agreed that we would set up a set of circumstances where on issues that we had to further resolve details, we agreed that we would have our chief of staff, the appropriate cabinet members and others sit and meet with one another to discuss the details of every issue that was raised, and we raised a lot of issues. Sung Kim, Associated Press.
Mr. President, you met with President Xi, and you met with him face-to-face after he had unquestionably consolidated his power at home. So now that you've met with him face-to-face, how do you assess his sort of posture towards the United States now? And did you find him personally to be more confrontational or more conciliatory and willing to compromise?
Neither and yes. Yes, I didn't find him more confrontational or more conciliatory. I found him the way he's always been, direct and straightforward. And do I think he's willing to compromise on various issues? Yes. I think he understands that, look, I think, how can I say this tactfully? I think the election held in the United States, which still leaves a little bit uncertain, has sent a very strong message around the world that the United States is ready to play. The United States is, the Republicans who survived, along with the Democrats, are of the view that we're going to stay fully engaged in the world and that we, in fact, know what we're about. And so I don't get any sense that there's more or less confrontation. We were very blunt with one another about places where we disagreed or where we were uncertain of each other's position, and we agreed we'd set up, and we did, mechanisms whereby we would meet in detail with the key people in each of our administrations to discuss how we could resolve them, or how, if they weren't resolved, on what basis were they not resolved. Sebastian Smith, the AFP.
Thank you very much, Mr. President. It's extremely close. Excuse me, I don't usually talk that loudly. Does the retaking of Kherson in Ukraine signal a turning point in the war, in your opinion? That the Ukrainians could realistically pursue their ultimate goal of expelling the Russians completely, including retaking Crimea? If so, does the US intend to support and facilitate that goal, as you've been doing so far with their other goals? Or would you perhaps see Kherson as a different kind of inflection point, basically a good time to start negotiating now that they've got some more strength than they had a few weeks ago?
First of all, it was a significant victory for Ukraine. Significant victory. And I can do nothing but applaud the courage, determination, and capacity of the Ukrainian people and the Ukrainian military. I mean, they have really been amazing. And I think it's hard to tell at this point exactly what it means in terms of, but I've been very clear that we're going to continue to provide the capability for the Ukrainian people to defend themselves, and we are not going to engage in any negotiation. There's nothing about Ukraine without Ukraine. It's a decision Ukraine has to make. I think you're going to see things slow down a bit because of the winter months and the inability to move as easily around the country. But I think it remains to be seen exactly what the outcome will be, except that I'm confident that Russia will not occupy or defend Ukraine as they intended from the beginning. I can't have trouble reading this. Reuters, Natanja Bose.
President, quick question on North Korea, which appears poised to conduct a new nuclear test. I'm wondering if you can talk about your specific discussions with President Xi on that. To what extent do you think China has the ability to talk North Korea out of conducting such tests? And what are the repercussions for U.S.-Chinese relations if a test goes forward?
Well, first of all, it's difficult to say that I am certain that China can control North Korea, number one. Number two, I made it clear to President Xi Jinping that I thought they had an obligation to attempt to make it clear to North Korea that they should not engage in long-range nuclear tests. And I made it clear as well that if they did, they, meaning North Korea, that we would have to take certain actions that would be more defensive on our behalf, and it would not be directed against North Korea. It would not be directed against China, but it would be to send them a clear message to North Korea. We are going to defend our allies as well as American soil and American capacity. And so, I do not think that it's difficult to determine whether or not China has the capacity. I'm confident China is not looking for North Korea to engage in further escalatory means, because I made it clear, and I made it clear from the very beginning and last year as well, that we will do what it needs to defend our capacity, to defend ourselves and our allies, South Korea as well as Japan, and that we'd be more up in the face of China, but it wouldn't be because of China. It'd be because of what was going on in North Korea. So, again, on a number of these issues, we have put together teams where our National Security Advisor, Secretary of Defense, and others are going to be engaging with their counterparts from China to see, and we're not going to be able to work everything out. I'm not suggesting this is kumbaya, everybody is going to go away with everything in agreement. But I do not believe there's a need for concern of as one of you raised the legitimate question, a new Cold War. And I think that I'll conclude by saying it this way. I want to be clear, and be clear with all leaders, but particularly with Xi Jinping, that I mean what I say and I say what I mean. So there's no misunderstanding. That's the biggest concern I have is a misunderstanding about intentions or actions on each of our parts. So we went into, I look at my team, how long did that meeting last? 3.5 hours. So we covered an awful lot of territory. And I must say that he was as straightforward as he has been with me in the past. And I think that we understand one another, which is the most important thing that can be done. I guess all of you are going swimming from here. It's not far. But
Mr. President, what should Americans expect from Congress as it relates to abortion rights after the midterm?
I don't think they can expect much of anything other than we're going to maintain our positions. I'm not going to get into more questions. I shouldn't even answer your question. No, I don't think that. I don't think there's enough votes to codify unless something happens unusual in the House. I think we're going to get very close in the House, but I don't I think it's going to be very close, but I don't think we're going to make it.
All right, thank you, everybody. Thank you.
The President of the United States there, wrapping up the press conference at the Grand Hyatt in Bali. Back with us now is Stifel's Brian Gardner. Brian, you followed that over the last 20 minutes or so. No big headlines from my side to read out. What's your big takeaway?
No, I agree. No big takeaways. The questions were kind of all over the place in terms of they covered a lot of territory beyond just the direct engagement with China. It went to Ukraine, it went to North Korea. So it's a lot of peripheral issues, and those are important, but I don't think we gleaned a lot new about the direct U.S.-China relationship.
It's the economic tension I want to explore a little bit more, Brian. In the readout from the White House, it said President Biden raised ongoing concerns about China's non-market economic practices which harm American workers and families. In the news conference, he said we will compete vigorously on the economy. Brian, how do you think that's going to manifest in the next year or so?
So it's interesting, even with a split Congress in the United States, there is some level of agreement on China. And actually, there's a competition between the two parties of who can be toughest on China. And so I think on these kind of non-market economic issues, as they put it, I think you're going to see some level of agreement on onshoring some more capacity in the United States, on going after intellectual property violations, on U.S. investment in China. So I don't know that's exactly what they had in mind, but I do think there is a consensus in the United States and thus into a competition on which party's going to look tougher on China.
Brian Gardner, as always. Brian, thanks for being patient, sir, as always, from Stifel. Brian Gardner there. Equity futures are down about 0.4% on the S&P 500 going into the opening bell. If you want to blame someone for 15 points lower on the S&P, maybe it's Governor Waller, who overnight said these rates are going to keep going up, and they're going to stay high for a while until we see the inflation get down closer to our target. We've still got a long way to go. I think he said calm down and take a deep breath. We're going to calm down and take a deep breath right now with Evercore's Julian Emmanuel and Canaccord's Tony Dwyer. Julian, let's start with the Fed speak yesterday evening, pushing back against the major rally last week. Any reason to believe, Julian, that rally can continue into year-end?
We actually do think the rally can continue into year-end. First of all, the seasonals speak for themselves. Second of all, you just saw the president and essentially, coming into this meeting with Xi, a major meeting, on his front foot in terms of the results of the last week. And frankly, what we're starting to find out is the moment is here that the market is embracing the fact that inflation is declining and potentially meaningfully. All of that bodes well for stocks stronger into year-end.
Tony, do you share that enthusiasm?
So John, we're talking about this in the temporary sweet spot. And by that, I mean, at some point when the economy peaks out, by definition, you're going to have lower inflation. I think the Fed rate hikes have certainly accomplished that very quickly. So you have lower inflation expectations. That was the first time you've had a rally in the bond market where the inflation expectations came down as well. And then you have the idea the sweet spot is inflation comes down, but you're not in a recession, so growth can stay positive. I don't think that's going to be the case next year. So to sum it all up, I love the data. So here's the data. The S&P 500, since it became a 500 stock index in 1957, the only time it's ever gone down more than 20% through the end of the third quarter and been negative in the fourth quarter was 08. We're not that. The other range of outcomes has been between 8 and 12%. So the fourth quarter rally that we've been looking for since the end of the third quarter, based on that data series, suggests now that we're up 11.3%, by year end, again, it's a year end, doesn't mean you can't go up more and then fall back, but by year end, in the history of the S&P 500 as a 500 stock index, even when it's down between 10, 15, or 20% through the third quarter, you've never closed the year up more than 12.1%. So, if you do get as significant as Julian says, if you get in a more significant rally, it would probably be a good idea to cut back some exposure.
Tony, I know you've got to run imminently, so I wanted to share Mike Wilson's view with you and get your thoughts on it. Over at Morgan Stanley, they've had the courage to press send on their outlook for 23. Not many people have done that so far, and for good reason. He talked about a volatile path to 3,900. He said, what's left of this tactical rally, we see the S&P 500 discounting the 23 earnings risk sometime in Q1 23 via a 3,000 to 3,300 price trough. goes on to say that the outlook is basically a very, very choppy road to 3,900 year-end next year, which, Tony, is basically where we are right now going into the opening bout. Do you share that kind of pessimism?
You know, typically, historically, as you know, Mike and I have been on a little bit opposite side of the trades, but for this entire year, after the very beginning of the year, we've been on the same page, and I agree with it. John, there's no way. So when I look at any time in that more than 75% of the potential yield curves are inverted, which is the case as of Friday. When you look back, anytime that's happened, you've been in a recession. So down 27%, that may be discounting some of the recession, but we're not down 27%. We're having what I call, again, the temporary sweet spot, where you have the idea that the Fed can generate lower inflation with a soft landing. All the data that I'm looking at suggests that it works with a lag, and we're going into a recession next year. So I think Mike and I are on the same page. And as you know, I don't have targets. I think, those are kind of made for TV at this point. So, again, I do see weakness, and it'll really depend on the Fed action. One last thing, John. Just like when I used to say, when you're channeling your inner Volcker, you better be careful you get what you wish for. When you're looking for the Fed pivot, if you do go into a recession, you better be careful you get what you wish for, because that has not been a buy signal over the last 4 recessions.
Tony, this year price targets have been for the bonfire, if anything, right. Many times. Tony, thanks for being with us, buddy. As always, Tony Duarte. Julian Emmanuel's going to stick with us. He's got a price target. We'll talk to him about it. Coming up, 2023 outlook starting to filter out. Morgan Stanley's Caterina Simonetti recommending investors stay defensive and focus on inflationary hedges. That conversation is coming up next. Coming off the back of the biggest weekly gain on the S&P 500 since June. On the Nasdaq 100, the biggest weekly gain going all the way back to November 2020. This Monday morning, futures negative 0.4% on the S&P. On the Nasdaq, we're down 0.7%. On a Russell of small caps, down 0.6%. As your opening bow, switch at the board and get to the bond market. And thank Governor Waller for this one. Yields up, Treasuries down. Yields higher by 5 basis points on a 10-year 3.8574. In the FX market, dollar showing a little bit of strength after some monster weakness last week. The dollar last week against the euro, worst week going back 2 years against the yen, worst week going all the way back to October 2008. In the commodity market, we're down 1.4%, 87.70 on WTI. In the equity market around the opening bell, about 20 seconds into the session, equity shaping up as follows. On the S&P, we are negative by 0.4%. On the Nasdaq, we're down by 0.75%. The Fed pouring cold water over the market's inflation relief rally. Morgan Stanley dropping its 2023 outlook and expecting a rougher road ahead for stocks, running the following. It's a volatile path to 3,900 after what's left of this current tactical rally. We see the S&P 500 discounting the 23 earnings risk sometime in the first quarter of 2023. They're looking for downside, potentially to 3,000 to 3,300 on the S&P 500. We caught up with Mike Wilson on Friday. Take a listen to what he had to say.
The earnings forecasts for next year are substantially too high, and we think that process of readjusting those estimates will begin in the fourth quarter reporting season, because that's when companies will have to address 2023 forecasts, which they haven't done yet. And that's the catalyst. There could be other catalysts as well, but that's the main one. It's basically the slowdown that will hit earnings significantly next year, even in the event that we avoid a recession, which we think is getting less likely. But if we do avoid a recession, that means less employment cuts, which means even worse operating leverage. So that ultimately has to play through. Does that mean new lows are guaranteed? No, but I would say a retest of the 3,500 level is probably pretty much in the cards.
Back with us is Julian Emmanuel of Evercore, alongside Morgan Stanley's Caterina Simonetti. Caterina, can we talk to you about the earnings weakness that we're expecting in the first quarter of 23, looking back to the last quarter of 22?
Jonathan, of course, we are seeing some of the earnings revisions in the third quarter already, which makes a lot of sense, but not enough, not quite at the levels that we're expecting. And so we are forward looking to the fourth quarter results, because with fourth quarter results, we're going to start seeing the estimates for 23 and 24. And we need to have earnings expectations set to a more realistic levels. In our view, that's what is going to be a catalyst that will push us over to the next bull market, at least one of them. And we can start positioning for that, but it hasn't happened yet. This is something that is absolutely necessary in order for normalization in this market, and for us to turn the corner. So as much as we want to think that this bear market is over, we think that there is, more volatility on the horizon. And that's why we're still staying defensive, and we're still recommending, kind of this outlook of focusing on yield, focusing on defensive sectors like, industrials and healthcare and financials and REITs, the competitive advantage, these companies cannot be discounted. And we're not ready to be risk on just yet, but we're getting there. We have to be tactical and forward looking in our asset allocation.
Katerina, if there is any remaining upside into year end before we get to that mess, is it even worth chasing?
Well, Jonathan, this rally makes a lot of sense. The exciting part is that we're getting to the end of the tightening cycle, and inflation is showing the signs of slowing down, but the risks that are on the horizon, like, I just mentioned, with the Fed that is going to continue raising rates, with the fact that inflation is affecting consumer behavior, is affecting, the forward-looking outlook. But these rallies, they're exciting, so what we can do is we can take advantage of some strategic positioning. We can use them to rebalance. We can use them for tax loss harvesting, and not every single part of the market is going to decline. To Mike Wilson's point, we are expecting, a leg down, but good quality companies and strategic positioning in sectors like, small cap, mid cap, international exposure presents a lot of value. Dollar is strong. So are there interesting buys that we can make right now towards the year end? Absolutely. We're ready to go there. We're ready to start looking and buy on dips. We're just not ready to give up our defensive stance, not just yet. This is our strategy going forward.
Gillian, this downside that Morgan Stanley's looking for, led by Mike Wilson, 3,000 to 3,300 on the S&P 500 at some point early next year. Are you going to wait around for that?
Look, if that happens, it's likely to be later rather than earlier next year, because if you go back to earnings, John, here's the thing. The buy side has stopped listening to bottoms up sell side estimates, okay? That's why stocks have rallied through this earnings season. That's why stocks rallied in the July earnings season, even as the numbers came down. And the interesting thing is, when you look at next year, the bottoms up for the S&P is around 230. Our number is 221.5, which is roughly unchanged year on year. But the buy side is actually forecasting 205 to 210. And so from our point of view, when you think about the fact that GDP is tracking at 4% for the fourth quarter after a positive last quarter, it's entirely possible that this recession is either going to be extremely shallow or not at all, and that earnings estimates in terms of viewpoint from the buy side are going to need to be revised higher, which supports the bullish equity case.
Equities right now down 0.4% on the S&P. On the Nasdaq 100, we're down by 1 full percentage point. This from Citi overnight, led by Stuart Kaiser. Timing is the key word for markets. For data, will inflation crest before growth deteriorates, and let the FOMC deal with those risks to its mandate separately? Can I come to you on that, Julian? Just the sequencing of what rolls over first, inflation or growth, and what it means for how the Federal Reserve is going to handle things next year.
So we're actually seeing inflation start to roll over first, because, factually, Ed Hyman called for the peak and the turn down in inflation in the middle of the summer. I think part of the reason that you had that response to last week's CPI report was that the market had its aha moment that is actually happening, and yet growth seems to be holding in. The question for us is it a pause or is it a pivot? it's not a pivot, okay? So the futures curve is pricing in rate cuts later next year. Those likely aren't going to happen, and at some point the market's going to have to accept that reality.
Katerina, I'm looking at your preferences, sector preferences, financials, energy, healthcare. Is that where you see the leadership next year?
Absolutely, Jonathan. We are looking at the positioning going forward, and specifically with tech. When you think about it, tech was the sector that led the last bull market, and we have to be realistic about the fact that this might not be the sector leading the next bull market. So as we look forward and as we look at our portfolios, we are kind of just staying back from tech. We're staying back from consumer discretionary, and we are looking more towards sectors with the pricing power, with strong cash flows, that are positioned well for the volatility that in our view is still to come. Sectors like financials, like healthcare, like industrials, commodities and REITs present really interesting inflation hedges, because inflation is showing signs of slowing down, but it is here to stay. We're going to be in this higher inflationary environment, and this is something that is going to play pretty big role in the portfolios. And that's why we don't necessarily have to do things going forward in exactly the same way that we've done them in the past. We have to make sure that we are positioning forward-looking and strategically and tactically to take advantage of the dips, to take advantage of the opportunities that this market would present. And in our view, again, the defensive sectors is the way to go, because right now, they generate the yield. And, on the other side, we're finally in the environment where we can make some money in fixed income. There are strategic buys there, and we specifically favor high quality corporate debt. It's really nice that we can go somewhere where in the market where that can generate the yield, but also give us some principal preservation, as a lot of investors are uncomfortable about levels of volatility that we're seeing.
There's some people calling that the new normal, but maybe it's the old normal. We're going back to a world that used to exist a couple of decades ago. The inflation one is a big one. It's a really important conversation. Got to talk about three parts of the story. You've got to think about direction, pace and destination. On direction, it's starting to trend a little bit lower, decelerating. Maybe that's a better choice of words. On the pace, let's see how quickly this happens. On the destination, where does this land next year? Goldman Sachs wrote this. Our forecast is basically for PCE to drop to 2.9% from 5.1%. Our forecast reflects three key factors. One, the easing in supply chain constraints in the goods sector. They go on to say a peak in shelter inflation post-reopening. And three, slower wage growth driven by the ongoing rebalancing of the labour market. That's the latest call from Jan Hatzian and the team over at Goldman. But Julian, I think you get quote of the week, buddy, from last week, off the back of the midterms, when you said this: the uncorrelated outcomes of elections across the US reinforce the idea that, much like stocks in 22, voters prefer governance and local issues alpha over political party big picture beta. Election integrity rhetoric likely moderates a win for everyone, you went on to say. Can you speak to that just a little bit more, Julian? The dispersion we've seen this year, and maybe the dispersion you expect to see next year too.
Yeah, so we think, look, if you go back to the end of 2021, you started this trend, and it makes sense given the Fed's hiking path, given above normal inflation, which, as Katerina pointed out, is likely going to be, something we're going to live with in 2023, if not into 2024. And at the time, strong economic growth. Now, we obviously don't really have that, but the whole point being is that is sort of soup is basically, really talked about the transition from growth stocks heavily concentrated in the index to value. And it's no surprise at all to us that the S&P 500 equal weighted index is handily outperforming the S&P 500 cap weighted index. We think that continues, and we think this is going to be an excellent environment for stock picking. And part of the outcomes are that, if you get a continued moderation in bond yields, perceiving the Fed potentially pausing in the first half of next year, that's likely to be good in a bond stock correlated world.
Hey, Julian, wonderful to catch up. Julian Emanuel, And the brilliant Caterina Simonetti there from Morgan Stanley and Evercore, respectively. Right now on the S&P 500, 11 minutes into the session, we're down 1/3% on the S&P. On the Nasdaq, we're down 1 percentage point. With your movers, here's Abby.
John, before we take a look at what is dragging this morning, causing those declines for the major indexes, let's take a look at what's working. And of course, it has to do with that 3.5-hour meeting between President Biden and President Xi. A conversation that President Biden characterized as open and candid. And of course, we do have the strong relationship between these two dating back to the Obama administration. China tech up about 15% over the last 3 days, including today. Alibaba up 1.6%, JD.com up 2.6%. NIO, the EV car maker, it has actually flipped to the downside, down 1.9%, probably having to do with that tone. But plus, you also have property stimulus out of Beijing helping China stocks overall, the liquidity. Now, here in the U.S., though, big tech is down. Microsoft down 2.6%. Amazon down 2.2%. This, of course, is yields higher, as you've been saying all year. Stocks down. Amazon also perhaps pressured by Jeff Bezos saying he plans to give the bulk of his wealth away through the end of his lifetime. And then very interesting, John, you would think that chips could maybe get a bit of a bid from that more positive tone between President Biden and President Xi, but not so much. Chips down 30% on the year, perhaps having to do, of course, with the tensions between the U.S. and China. Investors may be wanting these two to walk the walk and not just talk the talk. Let's see how that progresses, if maybe some of the hostility between the two around chips in particular lifts as the year goes on.
Abby, thank you. Coming up on this program, Binance offering crypto markets a bailout plan.
No one can protect a bad player, to be very frank. As industry players, we should be more vocal about it. We should set very strong standards for the industry.
That conversation up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Fed Vice Chair Lael Brainard. That conversation at 11:30 a.m. in New York, 4:30 p.m. in London. This is Bloomberg.
No one can protect a bad player, to be very frank. If a guy is very good at lying and is very good at just pretending to be what he's not, somebody wants to violate the law is not going to prevent that. The law can help to reduce that. As industry players, we should be more vocal about it. We should set very strong standards for the industry.
Cryptocurrencies turning higher off the back of talks of an industry recovery fund. This is the FTX story. Gets a new chapter. The company now facing a criminal misconduct probe by authorities in the Bahamas. Bloomberg's Katanga Johnson joins us now in the Bahamas, and Shonali Bassett joins us here in New York. Katanga, first to you. Bring us the update from authorities where you are.
Morning. Here in the Bahamas, we understand that the Bahamas Securities Commission, as well as the Police Financial Crimes Unit, has begun an investigation into Sam Bankman-Fried and others at FTX. They have not yet come to any conclusions around criminal wrongdoing. However, the investigation began yesterday, and as they continue to probe, once they come to conclusion, they'll make a recommendation to the public prosecutor here, who will then, if they do find criminal activity occurred, they'll be the ones who announce so.
Shonali, this drama, this soap opera, if you will, seems to get worse and worse every single day.
Revelations keep coming through, John, and one of them being the FTX balance sheet itself. The fact that they had less than $1 billion of liquid assets against about $9 billion in liabilities. So the idea that a bankruptcy proceeding here can recoup any funds here is getting pretty bleak. Now, I had a conversation late Friday night with Mike Novogratz, and I asked what is the ultimate effect of this. It's that people stop trusting other people, he said. So people keep on pulling liquidity off of exchanges. You see that play out through the numbers. You see almost $9 billion worth of withdrawals when it comes to Bitcoin, Ether, and other stable coins, which, as we know, has a direct link to the global financial system. So you do see some fear in the minds of people who are trading. Now, I will say I did talk to folks who are looking to buy the dip over this opportunity, but that does not negate this crisis of confidence that this industry is facing, and every venture capitalist that had poured money into this particular exchange, as well as others that are now feeling some pain as well.
Shonali, you've got to believe that this is about reputation now for institutional money. It's not just about risk reward. Surely there's a reputational risk for anyone who puts money into this asset class.
remember just how many institutions in the last couple of years have gotten very close to the crypto industry at large. You look at what happened with the stable coins, for example, what the Circle CEO said immediately after some of this had come to light, and it's that the assets are backed by U.S. Treasuries and other liquid U.S. assets, as well as custodied in Bank of New York Mellon. There's a big part of this industry that is very much connected to the financial system as we know it. That part has not been impacted in terms of, stable coins and other assets yet. But if there is a continued crisis here of confidence, will other crypto assets start to bleed into ways that are not impacting companies the way you're already seeing it being done today in the venture capital industry and every person that has put money into FTX?
What a mess. Shanali, thank you. Wonderful reporting. And to you as well. Katanga Johnson there and Shanali Basak. Got to catch up with Taylor Riggs as well. Bitcoin's correlation with stocks dropping to its weakest level this year. RBC's Laurie Calvasina taking it as a sign of limited contagion risk.
For the moment, I still view this as a contained implosion, but we do have to watch it. There's a tremendous correlation between the S&P and Bitcoin. And we do view Bitcoin as a risk barometer for stocks. Stocks have been sort of defying the carnage that we've seen in that space recently, but we'll have to keep an eye and, frankly, just see how bad this is.
Taylor Riggs has more. Hey, Taylor.
Let's talk about the risk barometer, John, that has been Bitcoin. Of course, in the last 2 days alone, you've had equities really find their footing after that CPI report. And then you've had idiosyncratic risk really hit the crypto space. And it's sort of broken down the classic correlation that we've typically seen between these two risk assets. A lot of investors have wondered what is the role of crypto, of Bitcoin, for example, in your portfolio as you think about an inflationary hedge, a classic risk asset, you name it. So there, of course, you're seeing a little bit of the difference today. Bitcoin, though, really trying to find its footing underway. This is not a normalized chart, John, on the right axis, but it is an overlay of Bitcoin prices and the S&P 500. So you can see the directionality of the two, typically moving in line. And of course, in the last few days, you're seeing a little bit of a difference in that. But historically, you have sort of, as Laurie was saying, seen it as sort of a classic risk correlation, if you will, there. Finally, John, this is sort of the chart of the last few weeks. If you think about the unprofitability, the ARK, the crypto, huge boost up in February 2020. Zero interest rates means that we can balloon all of our assets higher. Now that this Fed, of course, is raising rates, how are you thinking about the underperformance of these assets as we are all trying to figure out what these things are worth when rates are rising?
We're going to be doing this for a while, I imagine. Taylor, looking forward to the coverage with Remain coming up a little bit later on a close. Right now, we're down about 0.5% on the S&P. On the Nasdaq, we're down a little more than 1 full percentage point with the sector price action. Here's Abby.
Yeah, not surprisingly, John, with that modest gain for the S&P 500, as you were mentioning, down about 0.5%. We have split sector action. To the downside, it has everything to do with, not surprisingly, yields higher, tech lower, consumer discretionary down 1.6%. Amazon, a big drag there. Technology itself is down 1%. Real estate down 1.3%. Of course, those dividends look less attractive when yields are higher. To the upside, some of the defensive sectors, such as healthcare and staples. Now, if we dig in a little bit deeper on the day, of course, OPEC has cut its demand outlook for a second month in a row. On this, we do have oil down about 1.2%. But the energy sectors, John, this, of course, is where folks have been going to hide for 2 years. It seems as though that is happening again with those sectors really basically flat, turning higher.
Abby, thank you. More Fed speak still to come up next. Your trading diary from New York. This is Bloomberg. Governor Waller has some advice for us all. Calm down and take a deep breath after the big rally we saw last week. Is that what we're doing right now? We're down 0.4% on the S&P 500. On the Nasdaq, we're down about 0.9%. Yields are shifting higher. 2s out to 30s. Your 2-year right now up 9 basis points, 441.82. That's the price action. Let's get you the trading diary. Fed Vice Chair Lael Brainerd discussing the economy on a Bloomberg panel at 11:30 Eastern Time, sitting down with the wonderful Peggy Collins down in Washington, D.C. We'll hear from President John Williams a little bit later as well. US PPI and a meeting between Biden and EU Commission President von der Leyen happening on Tuesday. Looking forward to that. Then we get US retail sales on Wednesday, plus Biden meeting with the UK's Rishi Sunak as well, so he's got a busy week. And finally, another round of jobless claims coming up on Thursday from New York City. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. For our audience worldwide, this was the countdown to the open. This is Bloomberg.
News.